We're always talking about how to build a scalable business, but what about building one that can last for generations? I mean, not just hang on, but actually thrive for 100 years. Well, today we're going to dive into a business model that's engineered to do exactly that.
But before we can even think about a 100-year plan, we have to start with this killer quote from our source material. Seriously, let this sink in. Because if your basic model is broken, throwing more money at it and trying to grow just means you're going to have a much, much bigger crash. So many people get this wrong.
So that leads us to the big question, right? If you want to build something that's truly built to last, there is one single calculation you have to get right from day one. It is literally the difference between a business with a future and one that's just a professional money burner.
And that math, well, it's called unit economics. Before we jump into this incredible case study we've got lined up, we have to get our heads around this concept. It is the engine that drives everything. It's the secret sauce behind any business that actually stands the test of time. So what are they? It's actually super simple. It's the math of one. For every single transaction, every customer, every sale, how much money do you make or how much money do you lose? We're not talking about your total revenue or some vague profit margin. We're talking about the real dollars and cents on one single sale. If you know that number, you know the true health of your entire business.
Now, check this out, because this is so important. Not all unprofitable businesses are the same. On the right, you've got a model that can totally work. Yeah, you might lose money getting a customer in the door, but you know that over their lifetime they're going to be profitable. More scale actually fixes that problem. But the one on the left, oh, that is the danger zone. If you lose even a little bit of money on every single sale, getting more customers just makes you go broke faster. It's like pouring gasoline on a fire.
Okay, so we've got the principle down. Now, let's see how this whole unit economics thing plays out in the real world. We're going to break down this really unique luxury resort called Rocky Ledge Estates and figure out why its math is built to last a century. So here's the quick rundown. Picture this. Rocky Ledge is this amazing equestrian resort. It's got 8 private homes tucked away in this massive wilderness area. It's all about horses, ATVs, boats, the whole outdoor adventure thing. But the real game changer here, the thing that flips the script, is its totally unique shared cost model. And this is where you can really see the genius of it. Look at the difference. A traditional fancy ranch is all-inclusive, right? They charge you a huge per-person rate, maybe $500 to $800 a night. But Rocky Ledge, they use a shared cost model. You get 4 couples to split a whole house, which brings the price way down to around $250 a night per person. It's a completely different way of thinking. So here's the bottom line. The all-inclusive model bundles everything together for one high price. The shared cost model unbundles it. You get a much lower price, you take care of your own food, and get this, the whole setup naturally encourages you to go out and recruit your friends to fill the house. That keeps the place full and makes luxury way more accessible. But hold on, because that shared cost vacation, that's only half the story. There is a secret ingredient baked into this entire business model that turns it from just a cool resort into a full-blown, multi-generational wealth machine. And that secret ingredient is something called a REALP, a real estate limited partnership. Now, to put it simply, it's just a way for investors to put up the money for the property. In exchange, they get a slice of the income and some really big tax benefits, all while a general partner takes care of all the day-to-day management. Easy, right? And this is where the model just gets insane. The investors, see, they're not just buying a fancy vacation. They're buying an actual asset. An asset that gives them passive income, offers huge tax write-offs like bonus depreciation, and, this is the crazy part, it's all structured as a perpetual family trust. It is literally designed from the ground up to build and protect wealth for generations to come. All right, so let's put it all together. We have rock-solid unit economics from that shared cost vacation model, and we've layered on this super powerful investment structure. So what happens when we just let that run for 100 years? Okay, let's run the numbers. Based on the data, at that $250 per night rate for each couple, the projected gross revenue in year 1 is a massive $2 million. And this isn't some wild guess. This is a great start because the math works from the very first guest. But, a business doesn't just sit still. Prices go up. So what if we add in just a tiny, conservative 2% inflation adjustment each year to that nightly rate? Well, this is where the magic of compounding really starts to kick in.
And just look at how this thing snowballs. By the end of the first generation, we're talking just 15 years, the cumulative revenue is already over $48 million. But then it just takes off. By the end of generation 2, it's closing in on $170 million. The growth here isn't just adding up, it's multiplying on itself year after year, generation after generation.
And that all leads to this final, just mind-blowing number. Over 100 years, this single business is projected to gross over $874 million. That is the unbelievable power of getting your unit economics right and letting time do the heavy lifting. So, this all brings the lesson right back to you. The success of Rocky Ledge isn't some kind of financial magic trick. It's just simple, sound math played out over the long term. So the question is, how can you apply this same thinking to your own business or your own idea?
Because that's really the whole point of this. The foundation has to be solid from the very first customer you ever get. If the math on one sale doesn't work, I promise you, the math on 1,000,000 sales isn't going to work either. So here it is. Here's a playbook you can use, taken straight from our source material. Step 1, figure out your revenue for one single unit. Step 2, calculate every single direct cost for that same unit. Step 3, do the simple math, revenue minus cost. And then step 4, and this is the big one, you have to ask the killer question, is the amount of volume I need to be profitable actually realistic in my market?
So I'm going to leave you with this final thought. It is so easy to get wrapped up in the big vision, in the branding, in the hustle. But when it's all said and done, a business that truly lasts is a business where the math works. So, have you done yours?